Hello and welcome to our financial market review. As of today, two opposing forces continue to pull investors apart. On the one hand, economic figures show real recovery in activity, whilst on the other hand, there are mounting expectations of the end of the accommodative monetary policy following a potential overheating of the economy. The significant increase in job creations in the United States and the Senate having passed Biden's plan over the weekend tend to support investor optimism. But, on the other hand, we see institutional investors short-selling massively the US 10-year yield, thus seizing up the repo market where financial professionals borrow securities from other financial institutions. Such behavior may seem alarming because it pushes interest rate up very sharply and degrades the equity risk premium. Eventually, the distribution of $1,400 checks following the approval of the Biden plan should continue to push up long-term interest rates. However, if we look at more accurate figures of people actively looking for work, the latter remains stable at 11% of the active population. It is this figure in particular that the Fed is monitoring for possible monetary tightening. For the moment, it is still far from the target set by the Fed, and one should take into account Powell's comments that inflation will pick up but will only be transitory. The important test for the week will be the 10-year and 30-year bond issues as the yield continue to steepen following the approval of the Biden plan. These two bond issues are highly anticipated, while the last 7-year issue was catastrophic. On the European side, the European Central Bank, whose monetary policy meeting will take place on Thursday, will also have to elaborate on its objective following the tension in the yield curve and the European economy still lagging behind. In addition to the ECB meeting, the inflation figures in China and the United States will be monitored, as well as the revision of the fourth quarter GDP figures in the Eurozone. Stay tuned for our next roundup, and until then, have a nice week ahead.